we do have an expert voice joining us at this point in time, Seth Freeman, joining us to talk us through, the various factors that are spooking global equities at this point. Seth, good morning. Thank you very much for joining us. It started off by, I think most people suggested that this was a rate inflation-led sell-off in the U.S., but those no longer seem to be the primary reasons that are driving equities lower. In your assessment, what's going on here?
Well, we haven't had a whole bunch of more news other than concerns about inflation coming a little sooner, and mainly looking at wage inflation as a result of the tax cuts. I think maybe investors were becoming fairly complacent in terms of potential volatility. At the same time, though, we're seeing earnings, we're seeing fundamentals that look fairly strong.
Seth, good morning. Ira joining in as well. So I think overnight we got two more data points pointing to the same thing, that slack in the U.S. economy is quickly getting used up. The non-manufacturing index was strong, and within that, the employment component of the non-manufacturing index was at a record high. I saw one economist tweet that this is consistent with nearly 5% growth in the U.S. So clearly that whole story about wage inflation, which then feeds into rates, is very much at the back of the minds of the markets.
Yes, I think so. But, I don't know whether I would rely on those numbers because it's not consistent across the country. It's despite what the president was saying today on TV, we're not seeing, gigantic strides in manufacturing, hardcore manufacturing growth. And, the employment markets on both coasts are very strong, particularly strong here in San Francisco. But one of the problems I see is that the U.S. Deficit is going to increase. We're going to hit the debt ceiling much sooner than predicted, and that's partly because of tax cuts, the same thing that's causing somewhat higher wages, or at least bonuses.
Seth, good morning. All through 2017, the uneasiness around the low volatility was something that was spooking even ace fund managers. Now, we've seen the return of volatility. If I use yesterday as a benchmark, the jump up in CBOE VIX was exceptional. Do you think we are entering a period wherein VIX could be exceptionally high? Is it even possible to predict that?
Well, I don't think 2 days exactly make a trend.
True.
But maybe ask me a week from now. I guess what we'll really know when Americans are on TV complaining about their 401ks being hammered, as opposed to feeling great. I don't see this as of this moment anyway, don't see this as a big crisis because in general, the U.S. fundamentals are good. Europe's doing well. There's some concerns about Brexit and so forth.
No, which is why my question said that we know that there are two narratives out here, right? One narrative is the bullish narrative, which is saying that the micro is improving, the earnings are improving, so on and so forth. The other bit is that we've had an unusually low volatility period. We haven't seen a really large drawdown and seen investor behavior in that drawdown. We're probably seeing both of that. Can this get exaggerated?
Well, it certainly can if investors get nervous. And one of the downsides of so much index-based investing, so much passive investing, is that when investors are selling off ETFs, they're selling off a broad basket of stocks in one shot. They're not necessarily, like the old days, selling off individual stocks. So this can create a big wave, and we might see that in terms of sell-offs in broad international funds and even maybe broader emerging markets funds where stocks overall are being hit, even when the individual constituents in those indices may be fine.
Seth, do you expect this, this sort of setback to the markets or this fall to be short-lived, let's say 2 or 3 or 4 days, or do you expect this to be the trend for this year, given that we will see rate increases through the course of this year?
Well, I think it depends on the sharpness that we might see in the next few days. Investors certainly get very concerned when they see such striking declines in short periods. The most important thing, at least for retail investors, middle market type investors, non-professional investors who may panic, is to not view this, I think, at this point as a crisis. What happens a lot is nervous investors are terrible at timing markets, and they'll lock in declines and then be very slow in putting their money back to work. And this is really, I think we're going to see some interesting articles about robo-advisors and robo-investing, and see what happens when investors don't have human beings intervening.
Now, we're already seeing that. I think a whole host of comments from last night seem to suggest that this was a panic-less fall, mostly machine-led to that extent. We've been talking predominantly about the U.S. markets at this point. But what do you think the impact will be on emerging markets, especially markets like India? Could this lead to a substantial capital flow out of India, if anything at all? Or do you think that, that emerging markets will probably be less impacted? How do you view this?
Well, it was interesting, Friday in India, the market declined less than the U.S. did on the same day. So I think it's going to be negative, mainly for sentiment reasons.
Negative mainly for sentiment reasons. I have one quick last question. Your view on the dollar. We've seen some strengthening, which is a turnaround for the currency, despite the fact that we've had, U.S. government officials talk about how they prefer a weaker currency.
Well, I think that our cabinet member who stated he likes weaker currency was corrected by others in the cabinet. Obviously, the U.S. needs to have, cannot support itself on a declining currency, particularly, again, because these tax cuts are going to have some front-loaded effect. And so, no, we don't need a weaker currency. And higher U.S. interest rates should have the effect of strengthening the currency.
All right, Seth, we'll leave it there this morning. Thank you very much.